Hey there, awesome accounting student. Mark Franke here. This is video for Accounting 101, Chapter 12, the Statement of Cash Flows. This is the fourth required statement by Generally Accepted Accounting Principles, or GAAP. And this is a critically important topic because General Accepted Accounting Principles says that anytime you publish regular financial statements, you must include a statement of cash flows. This is what some people may call the banker's statement because this is what bankers like to focus on. And it's also, from an investor standpoint, an important statement because it does show whether or not the company is generating cash flow. And so in this statement, we're focused solely on the cash balance, the balance in the bank account or the group of bank accounts if we have more than one, and what the beginning balance was and where all the money came from, where all the cash went, and the ending bank balance. That's the purpose here. And in order to do that, we're going to analyze the beginning balance sheet and the ending balance sheet. But before we get into the mechanics of how it works, let's talk for a second about how these things are categorized on this statement. We have three different categories of cash in and cash out. Again, everything we're focused on in this chapter is cash coming in and cash going out. So the three categories are operating activities. Operating activities are money that comes in from customers and payments that go out to vendors and employees. So cash in for operations, cash out for operations relates to whatever business the company is doing. Investing activities are investments in long-term capital assets. Those are land, buildings, equipment, those kinds of things that take long-term investment. So if a company opens a new factory, or now it also could be if they sell a factory, if they've moved locations and they're selling one factory and buying another one, all of the money that comes in and goes out related to these long-term assets are considered to be investing activities. And lastly, we have financing activities. Financing activities is what we talked about in chapters 10 and 11 on capitalization. Anytime the company is trying to finance their operations by getting a loan or by issuing bonds or issuing stocks or those kinds of things, anything related to financing the business is going to be in that category. And we'll talk more about the mechanics in a minute. Now, there are two acceptable methods for preparing a statement of cash flows: the direct method and the indirect method. The direct method looks a little bit different, but both of these things are focused on the operating section of the cash flow. So again, three sections of the statement: operations, investing, and financing. All the difference is only going to be in the operating cash flow section. Financing and investing sections will be exactly the same, regardless of we do the indirect or the direct. We're going to focus solely on the indirect method. And the reason is, number one, it's what most companies use. There's very few companies, in fact, I don't know if I can even think of one that reports their cash flows on the direct method. Why? It's a little more difficult to get the information. Sometimes it may be impossible, but the indirect method has been used for many, many years by most companies, so that's why we're going to focus on that. And the indirect method, what we do is we start with net income, which is on an accrual basis, of course, and then we adjust it for changes in current assets and current liabilities, receivables and payables, and inventory, merchandise inventory, and that kind of thing. So by taking the balance sheet, and what we're going to do is take the balance sheet at the beginning of the year and the balance sheet at the end of the year, and we're going to calculate the net change. And then using those net changes, we're going to plug them in as either an operating, investing, or financing activity. So just to kind of give you a feel for this, increases in assets have a negative effect on cash flows. If you think about the most common asset, or the most obvious one, is accounts receivable. Accounts receivable is money that customers owe, right? So if that goes up, if accounts receivable goes up from the beginning of the year to the end of the year, that means those customers haven't paid us yet. The increase would have a negative effect on cash flows. Accounts receivable goes up, negative effect on cash flows. Accounts receivable goes down, that means more customers paid us, and that's going to have a positive effect on cash flows. So this works for all assets, whether it's inventory or receivables or even long-term equipment. If they go up, it means we spent the money, and that has a negative effect on cash flows. If they go down, it means that we sold some stuff, and that has a positive effect on cash flows. Now, naturally, as with everything in the accounting process, when we jump over to the other side of the equal sign and we talk about liabilities, it completely flips. So increases in liabilities and equity have a positive effect on cash flows. And you think about accounts payable. If accounts payable goes up, it means we didn't pay the vendors. And so we were able to retain the cash, and that's going to have a positive effect on cash flows. Or from an equity standpoint, if we sold some stock and common stock goes up, that has a positive effect on cash flows. And then the opposite is true if things go down. If accounts payable goes down, it means we paid the vendors more, and that has a negative effect on cash flows. If the equity accounts go down, like we bought some treasury stock, that's going to require cash, and that will have a negative effect. So let's do a little exercise. This is in your working papers. We're going to start, and I started with accounts payable as an example. If accounts payable goes up, that has a positive effect on cash flows, and I put a plus sign and a negative sign there. If accounts payable goes down, that has a negative effect on cash flow, and this is going to fall in the category of operating expenses, operating cash flow. Accounts receivable. If accounts receivable goes up, of course, we're on the other side of the equal sign. It has a negative effect on cash flows, and if accounts receivable goes down, that has a positive effect on cash flows, and this is an operating account, operating cash flows. Accumulated depreciation. If accumulated depreciation goes up, now because accumulated depreciation is a contra asset, it's going to be like a liability. So accumulated depreciation also is an operating item because we have depreciation expense that is recorded in the books. Bonds payable, liability. It goes up. It has a positive effect on cash flow. Any liability that goes up is going to have a positive effect on cash flows. And this is going to be a financing. Common stock, same thing as bonds payable. If it goes up, it has a positive effect on cash flows. If it goes down, it has a negative effect on cash flows. This is also a financing activity. Dividends payable. Dividends payable, same thing as common stock. If it goes up, that has a positive effect on cash flows. We haven't paid the dividends yet. And if it goes down, it has a negative effect on cash flows, and this is also a financing activity. Equipment. Equipment is an asset. When it goes up, it means that we had a negative effect on cash flows, and of course, if equipment goes down, it has a positive effect on cash flows, and this is going to be an investing activity. So think about it always first, is it an asset or is it a liability or equity? And then you can follow this. I'm going to, you just pause the video for a few minutes. I'm going to fill out the rest of this chart. Try to do this on your own. Pause the video, see if you can do it. This will help you. And then I will put the rest of these up for you to see in a minute. Okay, I'm back. Here is the completed worksheet. Hopefully you got these again in your head. You have to think about, is this an asset? Did it go up or down? If it went up, that has a negative effect on cash flows. If it went down, that has a positive effect on cash flows. Everything we're doing in this chapter relates to cash. One of the things I used to do in the classroom when we were in the classroom is show the video from the movie with Cuba Gooding Jr. as the football player, and Tom Cruise was the agent, and Cuba Gooding called up and said, "Show me the money." Well, this is the Show Me the Money chapter. Okay, so let's do a fairly simple problem. This is going to be problem 12.1b, and this is focused just on the operating activity section of the cash flow statement. And we're going to first calculate, this is in your book on page 490. And then I will do another video where we'll do a full-blown statement of cash flows. So this is just kind of taking baby steps. So the first step is to take the previous year amount and subtract the current year. So we're going to plug in these numbers. And excuse me, we're going to have debits be positive and credits are negative. Of course, accounts payable is a liability. It's going to have a credit balance. The salaries payable is a liability, and utilities payable. So I'm just putting all these in. Assets or debits are positive, and liabilities are credits. They're going to show as negative amounts. So this was 980. Okay, so what I'm going to do is take the previous year amount and subtract the current year every single time, because if that is positive, that means it has a positive effect on cash flows. If it's negative, it has a negative effect on cash flows. So you'll see that accounts receivable went up. That's why it has a negative effect on cash flows. Merchandise inventory went down. That has a positive effect. Prepaid insurance went down. That has a positive effect. Prepaid rent went down. That has a positive effect. Accounts payable went down. That has a negative effect. Accounts payable's liability, it went down. Now, again, if you just follow the mechanics of what I'm doing, is I am just taking the net change by taking the previous year balance and subtracting the current year balance. So now I have my changes that I'm going to then plug into this schedule on the left, which is going to be the operating section of the cash flow statement. So this company is the Salt Lake Company. This is a statement of cash flows, and this is for the year ended December 31, 2019. The cash flow statement, like the income statement and like the statement of retained earnings, covers a period of time. The balance sheet is a picture as a moment in time. From the book, they've given us net income as $20,000. Then we're going to add back depreciation expense. Why are we adding it back? Well, the reason we're adding it back is because it doesn't take any cash to record depreciation. So included in net income is an expense for depreciation that we didn't have to spend any money on. And that's why it's shown as a positive. We're adding that back to net income because we're trying to figure out how much cash was generated from our operations, and we're starting with net income. So we're adding back depreciation expense. I've already plugged in the increase in accounts receivable. We have a decrease in merchandise inventory, that's $120. We have a decrease in prepaid insurance, that's the $40. We have a decrease in prepaid rent, that's $100. We have a decrease in accounts payable. Of course, that has a negative effect on cash flows. So that's a negative $200. We've already done all the calculations over here in our schedule on the right. So now we're just plugging these in. Increase in salaries payable has a positive effect on cash flows. It's a liability that went up. And same thing with utilities payable. It's a liability that went up. So now when I total everything up, I get net cash provided by operating activities of $51,960. $51,960. You might try doing this one over again and then do problem 12.1a after it, again, just to kind of get a feel for how this works mechanically. And then I'll be back with a different video with doing a full-blown cash flow statement. So that's it for now. Thanks for listening. I'll see you again next time.